Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic, people are still fearful. Michael, your topic.
Thanks, Dallas. So we've been conducting a lot of first meetings lately, and certainly a lot of Money Over 50 listeners have been taking us up on our offer. As you know, we offer that first Zoom meeting, free of charge and obligation. And you can contact us at podcast@mo50.com.au to take that up. So in conducting a lot of first meetings, a lot of local first meetings, a lot of first meetings via Zoom from listeners, a couple of themes keep coming up. And some of the questions that I've been hearing a lot of is now a good time to invest is one of those questions. Another question is, I have a lump sum of cash. Should I dollar cost average that in over a number of years, which means drip feeding that money in over a period of time? What's going to happen to share prices when the RBA starts to raise interest rates?
Yep, I've been hearing that one a lot.
So these are the questions. So, I mean, they seem like simple enough questions. However, what it tells me, these types of questions really are a symptom, in my opinion, of some underlying fear and panic.
And just to clarify, this isn't a dig at people asking those questions.
No.
These are valid questions, and what the point you're making here is just that this is more a sign of the economic conditions or the time that we're in. It's these are all valid questions.
All valid questions. Certainly. So the whole idea of this podcast is for people not to make the fatal mistake the next time we see such a big, the next time we see a significant drop or a decline in the values of these companies. So we've had a pretty good 13.5-year run. So March 9, 2009 was the bottom of the global financial crisis. Since that period of time, we've had 13.5 years of pretty much straight up rates of return. I think that leaves people more susceptible than ever to making the critical mistake at the wrong time. So I'm going to talk a lot about sort of what happened in the global financial crisis and sort of some of the things that happened. I was an advisor back then, and I can remember it. And the people that I didn't think would panic, a lot of them panicked, and some of them actually got to the point in time where they just couldn't cop it anymore, and they made the fatal mistake, unfortunately, of selling out at or close to the bottom, and they've missed out on that. Not only did they sell their shares for cents in the dollar of the great companies of Australia and the world, they actually missed out on
the next
13.5 years. So basically, these types of questions that come up, again, all valid questions, I still think people are inherently fearful of investing into the great companies of Australia and the world. You can present people with 30-year data. You can present them with 13.5-year data. And we're sort of at the period of time right now where I think because returns have been so good for so long, some 13.5 years. Of course, we had a little bit of a blip last year, but that drop of 37% in March, listeners here might say, well, I didn't panic during that period of time. No one had time to panic.
I think
that's
a great point, because we've said the returns in the last 13.5 years have been straight up and to the right. If you look at this if you actually look at the graph of this, last year that drop during COVID was literally a blip. Like if you look at it over 13.5 years, it's been straight up and to the right. Oh, what's that little spiky line down and then straight back up? And so it's a very different. The fact that people are still more worried about downside risk and more worried about what can go wrong than about than about trying to shoot the lights out. It's a really interesting thing because you go, we have had a 35% drop in the last 18 months, and yet I don't think that didn't have the same impact. And I think that's your thesis of this, is that it didn't have the same impact as the GFC had.
It didn't hang around.
Yeah.
In fact, it was a flash.
Yeah.
It was basically, we bottomed out in a bit over a month.
Yeah.
So it was the fastest fall of all time and one of the fastest recoveries. So it dropped. It was sharp.
Yeah.
It fell 37%. What happens is some people panic straight away, and a lot of people did. Other people that would have panicked, and I'll talk to you about real-life examples of the global financial crisis. A lot of people panicked at the second wave, and we just didn't have that in March last year. So I think people are susceptible. I think more people than we think are susceptible to a deep and protracted drop.
Yep.
When that happens, not if that happens, when that happens next.
Yeah.
And the worst thing that can ever happen at that point in time is that you panic at the wrong time. We always have that saying, if you're going to panic at the top. Panic before the volatility comes, and just don't own.
Just to clarify, Michael, the point you made there, because I think we just sort of glossed over it, is that when you say people are susceptible to that drop, you have to be susceptible to that drop. We've talked before a lot on this podcast about here. You have to be invested in most cases predominantly in the biggest and best companies in Australia and around the world. You can't not be susceptible to the drop. What you're talking about being susceptible to is the panic selling at the bottom, and that's the issue. We're not saying, well, people are susceptible to the drop. You should be invested in a different way where you don't experience the drop.
No.
What we're saying is that people are probably emotionally not maybe as equipped to handle riding that out as or maybe not as ready for that, or as emotionally ready for that as they should be.
That's what I believe. Certainly the drops are naturally occurring phenomena.
Yeah.
And they've occurred many times in the past, and they'll occur many times in the future. It's natural and occurring. You can't have returns of over 10% per year for 13 and a half years. You cannot have that without the volatility. It doesn't exist. Yeah. The returns without volatility are currently 0.35%. 0.35% is the 1 year term deposit rate. That's the return for no volatility. If you want to achieve, which most people needed, our clients that we see on average need an 8% plus rate of return per year on average. They need to be accepting of the volatility. And my thoughts is that as a group of investors nationally, we're susceptible to a deep and protracted drop because it's been just smooth sailing for so long. So during the global financial crisis, so I'll just take everyone back as to what actually happens. The markets actually peaked in the fourth quarter of 2007. Mm-hmm. So basically late in the year of 2007, the Australian markets and the American markets, pretty much all around the world, peaked at that point in time. Then they started to drop, and then they dropped, and then they dropped. And by September of 2008, so nearly 1 year after it started, the great companies of Australia were down by 26%. So they dropped 26% over that 12 months and then hung around at 26%. So almost 12 months after the start of when they started to drop, they got to 26% down. Now, that was a long 12 months for people.
Oh, yeah.
Recognize that the media is actually saying each and every one of those days, this time it's different. What we have coming, the world's going to end, capitalism's over, all those types of things. So people, it's funny because, again, people can anecdotally look back at 30 years of returns or 50 years worth of returns, and they can say that, we wouldn't panic when we see those drops. It's a very different lived experience. Very different. So by September of 2008, almost 12 months later, the great companies of Australia and the world were down by 26%. And then all hell broke loose. So in the third quarter of 2008, so around September, October, it was exactly September and October, the markets fell another 14% in just over a week. So what happened on September the 26th, we're at 4,904 points in the ASX 200. It then fell to 3,960 points. So in 1 week, after a year of protracted decline of 26% hanging around, all of a sudden, in just over a week, another 14% happened, and we were then down 40%. Now, a heap of people panicked at that second drop.
Which you can,
that's a huge drop that you have off the back of a 26% already drop.
Yeah.
You get another 14% in 1 week. The newspapers were just absolutely full of the world is coming to an end. This time it's different. The media always says this time it's different.
Yeah.
So it's never different. The catalyst for the drop is different.
Yeah.
What is actually happening is the same. Mm-hmm. It's deep panic. People are selling. For every seller, you have to have a buyer. If I have 100 sellers panicking and selling something, and I only have one buyer, the price hasn't got anywhere to go but down.
Yep.
And so we had that 1 week that took people to it took us from 26% down to 40%. Another 14% it fell in a bit over a week, and that just knocked a lot of other people out in terms of their panic. So they said, I can't handle this. I can't handle this anymore. I had clients at that point in time, not in this business, but in another business. We had clients that panicked and sold out. Not a great deal. Everyone was scared. Yeah. Everyone was scared. So we were down by 40%, but we were still 6 months away from the inevitable bottle, and another 17%. So the markets fell another 17% over the next 6 months. Yeah. And everyone thought this time is different.
Yeah.
So we were down, we're heading down to 57%. And that was pretty much 18 months after the markets had started to fall in 2007. We got to what no one knew at the time, but we got to March 2009 at 57% down.
Yeah.
And that was the day that the last person that was going to panicked.
Yeah.
And I say that because that's always the case at the bottom of the market when no one is left to sell.
Yep. The price only has one way to go.
The price has only one way to go, and you now have 100 buyers for every one seller as people race to get back in. Now, so there was 3 distinct periods. People I think always picture volatility as what happened in 2020, where it went straight down and straight back up. Yep. So what we're seeing here, what usually happens. The first wave had us down by 26%. That wasn't all the way straight down, though. It fell 10%, then it rallied 5%, then it fell another 15%, then it rallied 10%. So it's like the teeth of a saw. Yeah. It's going up and down, up and down, up and down, and people are becoming more and more despondent as they think it's rallying. Yeah. Because it drops 10 and then it rises 5 and then it drops another 15 and then it rises.
And it feels worse than if it just dropped 10 and stayed there. If it just dropped 10 and stayed there, people go, okay, that's where it's at. But it's come back up and there's a bit of false hope and optimism going, maybe the worst is over.
Maybe the worst is over.
Yeah, so I think that's...
So we had round 1 that took 12 months, 26%. Round 2 was a very, very... It happened in just over a week. I can't remember. It's all a blur, but I think there's some big banks went broke in America in 1 week. Bear Stearns, I think it was, dropped by 14%. Just sent shockwaves around, and a whole raft of people panicked.
Yep.
And round 3, when we were down by 40%, people assumed the worst was over, and then it fell a further 17%, and that just freaked so many people out, and understandably so, to take us to the drop of 57%. Now, the years before that, what I saw was people became a little bit flippant about volatility.
Yeah.
Because we had another good run before that. And I'm not predicting that 2021 or 2022 we're going to see another global financial crisis. Not at all. This is not what this podcast is about. What it's about is I still think people, I go back to the questions that are being asked now, and people are shrugging off the people's attitude towards volatility, I think, is going to come out when we do see a deep and protracted, whenever that is in the future. And I think there are going to be a lot of people that do panic at that point in time. I suspect this. I have no way of knowing this right now. I guess the point is nor does the listener. So if the listener's out there listening and thinking, I'm not going to panic. The maybe you won't. Yeah. But certainly the living through that is a very, very different experience. So I mean, we know some certain things. So owning the great companies of Australia and the world is one of the best ways to ensure that you don't run out of money during your retirement, and that you outpace the rate of inflation. Just the last 30 years, we got presented with the data just the other day, Dallas, didn't we? So the top 500 companies in America are up 10 times from where they started 30 years ago. So their return's been, I hate this terminology, but 10x. People understand what I'm talking about. It's 10 times from where they started. Yeah. The cost of living is only up 2.3 times over that period of time, as per Ibbotson, I believe, is the data there. So anecdotally, it's very, very easy to look at those figures and say, that's easy.
I'll just own them.
These companies started 30 years ago at a certain point. Then now, 30 years later, 10 times. The ironic part of that for me is that what happened exactly halfway through that 30-year time frame.
Yes.
What we've just been talking about happened. The global financial crisis happened.
Yep. Which was
exactly halfway through
years of downturn, a 57%
which was years of downturn, 57% down. Years. And with that occurring right in the middle, 30 years later, those companies are up 10 times what they were up. Now, again, I think people can actually say, I can understand that conceptually.
Yeah.
I can understand that if that were to replicate over the next 30 years and we were to see a situation that halfway through the next 30 years, we saw a 57% drop, I wouldn't panic. And I think people can conceptually say that. Some, I can tell you from experience, more than half will probably panic at the wrong time, at that point in time. What do you do about that? There's a couple of things you could do. One of which is, and this is, I think we don't talk enough about what we offer during that volatility because we haven't seen it for the last 13 and a half years. We're 11 years old as a business. We haven't seen any volatility in that 11 years. No. Virtually, we've hardly seen any volatility.
Yeah.
I think we had a short 15% drop back in 2011 or 2019.
There's a 19% drop.
19% drop. That was a quick one as well, and quickly recovered. And we saw 37% last year. We don't talk enough about what we do in times of volatility because we just haven't had that volatility. One of the things what we offer, if you choose to engage us as your financial advisor, is as close to an assurance that you won't make that mistake. So the big mistake is that we get a 40% drop or a 57% drop. Someone actually he understands things conceptually and understands intellectually. They just get beat down by the fact that it's 18 months worth of negative news and I just can't take it anymore. Get me out. Let's go to cash. What they're doing at 57% depressed is selling their shares for 43 cents in the dollar.
Yep.
Or they're selling their $1 million property for $430,000 and waiting till it gets back to $1 million before they try and buy it back. People never recover from that.
You can't. Yeah,
they do not recover from that. There's people that made this mistake in the global financial crisis that currently have of half of what they need to be retiring. And if they'd just been able to hang on and not do anything silly at that point in time, then they'd be twice as positioned to be able to retire at that point in time. So I say that engaging us as your financial advisor is as close to an assurance that you won't make that mistake, because we will fight tooth and nail to not let you make that mistake. It is your money, and we always say that. So we have a volatility document that it's an investment policy statement or a volatility document that states what we will and won't do when we see the next 57% drop. One of which is we're not going to try and get you out before that drop, and we're not going to change your investment strategy. We're not going to go to cash. We're not going to do anything. We're just going to do nothing. The last sentence of that is that we're going to try and we're going to fight tooth and nail to try and stop you from making that mistake. It is your money, and you are free to do with your money what you choose to. So we can't actually force people's hand at that point in time, but we can be very clear with them and what we're going to do and what advice that we're going to give them. So Nick Murray, who's a mentor to us, says that we get paid as advisors to stop people making that mistake, and the tax planning and the financial planning and the retirement planning is all free. Because our biggest value add is to stop people from making the critical mistake that they never recover from. We've brushed over that. We've brushed over that in our podcast because we talk a lot about volatility. We don't talk much about our role in that period of time. Because of the fact that we just haven't had it. We just haven't had it. We do charge. We charge percentage-based fees. I'm digressing here a little bit.
No, but I think it's very relevant.
So we charge percentage-based fees
for this reason.
And the reason that we charge percentage-based fees are that when there's a 57% drop, our income as a business drops by 57% for that period of time because we charge a percentage-based fee on what effectively the
retirement savings,
savings of our clients. So where that gives our clients confidence is that we tell them, hey, look, if we could have got you into something that didn't drop 57%,
we would have done that.
We would have done that. Because our revenue wouldn't have gone down by 57%. If we thought this thing would never recover,
and we thought you should,
we thought you should be in something else, we would already have you in that. Because of bearing in mind, we want our revenue to go back up to what it was. There isn't, and we didn't, and we won't. And the reason is this thing is going to recover, and if it didn't, we cease to exist as a business effectively. If this stays down, if this goes down 57% and stays down, we cease to exist as a future business. Now that gives people confidence that we're actually in it with them, and we're not just saying it's not just words on paper at that point in time. Again, one of the biggest things that we offer is to stop people from making that fatal mistake. As an advisor, we just haven't seen that. We just haven't seen that in recent times. We communicated with our clients last year when we were we communicate at 10% every 10% increment. So we saw a 10% drop increment. By the time we wrote the letter, we were down 14%. I went back and checked it. So we wrote a letter to our clients saying everyone hang in there.
This is a naturally occurring.
We wrote another one at 20% down. And then all of a sudden it turned around. And we met with some clients. You had some phone calls, of course. Dallas, you've spoken about your client who was exercising with some friends who had all made a mistake and moved to cash. And he was thinking of doing the same sort of thing. You talked him into hanging in there.
Yeah.
And he's forever grateful, of course, and has made significant amounts of money by doing so.
Yeah, and that's I think
it's one of those things that just because a drop of 30% or more tends to happen every 5 to 6 years. We haven't seen it. And that drop of 30% or more isn't typically like the May 2020 drop. It's not over in a month.
No,
it's over in 6 months, or it's over in 12 months. It hangs around. Yeah. It hangs around. We just haven't seen that. And just lately, with some of the questions coming up, and they're all valid questions, and this is certainly not to say these questions are silly or anything like that. But the underlying part of that, I believe, is that people are still very, very fearful, and they don't understand what they're investing into. Mm-hmm. And that tells me, I suspect, again, I have no way of knowing this, but I suspect that we get a deep and protracted drop, that without the right guidance, a lot of people make a fatal mistake.
Yeah. Well, let's say that's one of your best, mate. I was very inspired by that, but I didn't want to interrupt you and interrupt your role there, but a few thoughts I had as you rolled through this. To start, I couldn't agree more with pretty much everything you've said. It's in my experience of this industry, I know that's our value add. I've looked at all the research, and I've seen all these things, and I've seen these things play out on smaller scales. But it is a very different experience, and the analogy that I'd use there is it's like when you're watching a boxing match. If someone gets hit with a good clean punch in the first round, they tend to sort of shake it off and bounce back up, and away they go. When you've been worn down over 7 rounds of someone racking up some damage to your body, and you start to run out of puff, and then you get hit with that same punch, it's a very different experience. And I think that's what happens with a downturn, is that 14% drop in a week. Similar things happened in COVID last year, but it was like it was the first round of a boxing match. We were all still so fresh, and we were all still. And the other thing that happened was that we were all, most people around the world were more thinking about the health outcomes of COVID than necessarily about their retirement savings. So that was a very interesting experience, because you did, like we said, we did see some of that. We communicated that with our clients. We got on the front foot. We had some conversations with clients, but we had very less than probably what we would have expected based on a 35% drop. But you're dead right, that 35% drop is a very different experience if it's over the course of 12 months versus 1 month. That I think absolutely, because we know that another big drop is coming at some stage, and more than one for a 30-year retirement. We talk about this endlessly with our clients, because you mentioned the point before that when my client was worried about, that his mates that he was exercising with had all moved into cash, and he was worried, should he do that? And you sort of said that I talked him out at that point in time. That's not necessarily what actually happens. You can't explain these concepts to someone at that point in time. You can only remind them. And the only reason that worked is that these are really good clients, and they're intelligent people who listen and follow the plan. And so really all he needed at that point in time was a reminder of, just reassure me that we are doing the right thing, and that I haven't missed something here, and that you it was basically just a transfusion of my faith in the future into him. And he knew that we talked to this intellectually. I know I just need to stay the course. I just need to hear this again. Yes, you're doing the right thing. Don't panic. Don't do anything. Just sit tight. This will work itself out. And it just so happened that was the very bottom of the market on that day. But it's a very different thing to remind people of this, which is why we have these conversations all the time, both in this podcast and with our clients. We're having these conversations, and we're talking about it so much that we're like the boy who cried wolf for a lot of this. Like when we talk about volatility now, people are going, yeah, I know you've been talking about this for 10 years now, but it just keeps going up. Like, what are you banging on about?
It's awfully late. I always thought it's awfully late to be talking about it when the drop's actually happening. Yeah. So you can only talk about this, and you can only talk about it all the time when the markets are good. So for the record, today when we're recording this, the S&P 500, the largest 500 companies in America, are up around 4,300 points. Yeah. and the ASX 200, what's about 7,200 points or something like that, isn't it? I think so. At this point in time, so there you go. It's time stamped, or value stamped. Yeah. So we're having this conversation right now when things have never been better.
Yes.
So we've had 13 and a half years of good returns, and we're at all-time highs.
Yeah.
Looking forward, we're at all-time lows.
Yeah.
Because the profits of these companies are going to continue to grow and grow and grow and grow over time. But looking back, we're at all-time highs. So it's awfully late to be having the conversation when you are 40% down.
Yes.
And saying to people, this is what's going to happen.
Yeah.
We build into people's plans the
inevitable drops.
The inevitable drops.
Yeah.
And we tell them during good times what we will and what we won't do, exactly how we're going to behave during that period of time, how they're going to behave, how we're going to guide them at that point in time.
Yeah.
I've heard a client said to me one time that he thought paying my fee was like an insurance policy.
Yeah.
If that's the way you need to think about it, you could do 10 or 15 years worth of great work, and it can all be undone in the period of 6 months or 12 months when the market falls 57%. Not trying to scare anyone here.
Yeah.
This person said, I see your fee as an insurance policy that I won't make that mistake. And again, like our mentor Nick Murray says, he believes that's what we get paid for. And the rest of it's free that we throw in there, which is the tax planning every year, and the maximising your tax returns, and the working out exactly how to fund a 30-year retirement, getting you to retirement, and making sure you never pay $1 of tax again, to name just a few of the things that we do. Nick says all that you guys do for free. What you do is you stop you stop your clients making the fatal mistake at precisely the wrong time, and that's what you guys get paid for.
I think that's exactly correct, obviously. And I think just one final point before we wrap up is that, again, it's sometimes the point here, or where we see our role as why we think it's important to have that plan in place and to have someone that you are accountable for and that you are discussing this experience with as you're going through it, is that, again, for human beings, it's very hard to hold two conflicting thoughts in your head at the same time. And so we've touched on this before. This is why you have a coach. This is why you have a personal trainer. This is why you have a corner man in a fight. Is that the two conflicting thoughts in a downturn? And what we're trying to set people up throughout all of our discussions is to go, yes, your superannuation balance has dropped by 30%. I know that's painful. That's one thought that you're having, is I'm experiencing the pain from that. The conflicting thought is you must not react to that. You cannot panic and move into cash. You cannot react to this at all. I acknowledge and I'm aware of your pain and how uncomfortable that is. However, at the same time, I cannot let you do anything about that. You just need to ride this out. And that's I think that it's not that we're some super genius or we're some robot, although a good mate of mine always does tell me I'm dead behind the eyes. So it's not that we're not.
I think of you more as Mr. Spock from Star Trek, just pure logic. Like I always go back to the episode where Spock had to do this logical thing that was going to save more people, or they were going to kill his sister, and he said, more or less, kill my sister. I've got to do the logical thing here. So he's purely a logical man. So
but I think that's the point. Is yes, I am. I like to think that I'm reasonably logical, but all you're doing is you're often outsourcing some of that, holding those two thoughts in your brain. Is our clients are experiencing the thought of this is really painful. And they're getting a top up of that second thought from us, which is, yes, I know that's painful, but remember our plan. Remember we talked about this. Remember that you cannot react to this. You must not react to this. We have to just ride out this volatility. And so trying to hold those two thoughts in your own head is very tricky. Having them with someone else is easier because you've sort of got someone to top up those and I guess make sure that you are looking at both sides of that experience. So... But I think that's been a cracker from yourself there. I've just added in my thoughts, but have you got anything else before we wrap up? I think you've covered the lived experience of that is a really interesting one because, like we said, it's easy for us to sit here and go, we'll react in this way. But as you say, talking about the scars of living through that, both for clients and for yourself, is a very different thing to what we've experienced in the last 13 and a half years.
Yeah, look, no one's having any fun during that period of time. Like it's not fun. And you would think, well, why do it?
Yeah.
Well, because we have to.
Yes.
And we have to because the alternative at 1% rate of return or 0.35% rate of return, which is cash and fixed interest, is just not going to get it done.
No,
it's not going to get it done for people. So, we have to get the types of returns that we need to get. We have to not only accept but embrace volatility. Embrace it and say, okay, well, I know that to get these 8% plus sought after rates of return, there's going to be times where I have to accept, a drop of 30, 40%. And it's going to hang around for a period of time. I go back to saying that 30 years ago, the last 30 years, the top 500 companies in America have gone up 10 times. And right in the middle of that was a 57% drop. So that's inclusive of that drop. Like things recover. Like it, the world does not come to an end. These companies go on and make profits. It's people panic and push the price down, and it gets to a stage where it eventually turns around and starts to move up. No one's having fun during this period of time. We're not doing this to get a thrill out of it.
No.
We're doing it because for our clients, it's absolutely essential that they hold. And notice the word hold. Hold these companies forever. These good companies forever, which is not getting out of them at the wrong time, which is the natural reaction to
that sort of drop.
To a lion's chasing me. What do? I got to run. Which is probably what's probably the wrong thing to do if a actual lion is chasing you. They always say that. But it's certainly the wrong thing to do when markets are falling. So I think that's about it. I feel drained after getting all that.
That was like a therapy session, mate. That was fantastic. You really let us in there, so that's great. And thanks to everyone for listening to Michael's unpaid therapy session. Cheers.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. We look forward to catching up again soon.